Hey everyone, it's Richard. You're watching The Plain Bagel. There was a bit of drama in the finance space on X this past weekend when we saw Dr. Gad Saad, a Canadian marketing professor, author of the book Suicidal Empathy, and Joe Rogan podcast guest, make a post on X wherein he was lamenting about a so-called Canadian exit tax. You see, Gad is planning to leave Canada for the United States, citing the country's taxation and immigration policies. However, in this post, he talks about having a sobering meeting with his accountant about how much he'll be forced to pay in taxes when he moves out of Quebec, Canada, with later tweets suggesting he's facing tax rates in excess of 55% or 65% when all other taxes are added in. Now, Gad, if you aren't familiar, is an academic who's a fairly politically charged person. He has a history of berating Canada and the so-called woke mind virus. And with the past year of 51st state rhetoric and the like, as you can imagine, the post got a lot of traction on the platform, reaching 4.8 million views and a bunch of quote posts, with people both fiercely supporting Gad and criticizing the Canadian government for discouraging entrepreneurship and coercing people to stay in its borders, and others fiercely criticizing Gad for lamenting taxation as the source of his quote worst incidents in life and comparing it to being trapped in a Kafkaesque prison, despite the fact that he's clearly doing well financially. Now, the conversations around these posts got pretty political, with some even engaging in the grander debates over the ethics of taxation as a whole, which frankly, well above my pay grade and well outside the scope of today's video. But amid these conversations, we saw a lot of this misrepresentation of what this exit tax actually is, whether intentionally or otherwise. Because yes, Canada does have a so-called departure tax, but it's not this flat wealth tax that takes the majority of your money when you try to leave, like many people seem to walk away believing. So as with all Canadian finance topics that make their way into these online discussions, I couldn't help myself and figured I'd post a video explaining how this tax works, how high it can potentially reach, and how it compares to other countries. Because while a lot of these posts were criticizing Canada for having this type of policy, it's actually fairly common among developed countries, with even the United States having its own version of an exit tax, albeit there are some key differences, which we'll touch on later in the video. Now, importantly, while this is a topic I'm familiar with, given my work as a registered portfolio manager and CFP professional, I am not a tax accountant or a CPA. So please, if you find yourself in this type of situation, do engage for qualified advice on the topic, but we can at least clear up some of the common misconceptions and cover the broad strokes of how the tax works. So, what is this Canadian exit tax? Well, the tax is properly known as a departure tax, which is charged whenever someone changes from being a resident of the country to a non-resident, which is a condition that's satisfied when someone leaves Canada to live in another country and when they sever their residential ties to the country. Now, these residential ties can be up for interpretation, but generally speaking, they include owning a home in Canada, having a partner or dependents in Canada, or a number of other secondary considerations, with courts also considering whether you set up ties in this new country when determining your resident status. So someone can leave the country to work or study abroad and still maintain that resident status, so long as they maintain some connection that makes it possible or likely for them to return. However, when someone severs their ties and becomes a non-resident, then we have what's called a deemed disposition, which is when someone's assumed to have sold all of their assets and bought them back immediately the day before they become a non-resident for the purpose of charging taxes on any assets that have appreciated in value. You see, the Canadian government views capital gains, which is when you sell something for more than what you bought it for, as a form of taxable income, just like the United States. Both countries discount the tax rate charged on capital gains to incentivize people to invest their money and take on risk rather than just hoarding cash. But nonetheless, whenever you make a profit by buying and selling stuff, the government wants a slice. Now, in Canada, capital gains are taxed at half of your marginal income tax rate, or put differently, only half of your capital gains are taxed as income. So if you buy a stock and later sell it for a $1,000 profit and your marginal income tax rate is 30%, then you would be paying $150 on that realized capital gain, which is equal to the $1,000 times 50% times 30%. Now, typically, you only pay this tax once you actually sell the asset in question or realize the capital gains. But in this case, with a deemed disposition, you're being charged capital gains tax on your unrealized capital gains since you haven't actually sold anything, which, yes, does bring forward that tax payment. But the mark-to-market also resets your cost basis and any sort of tax liability you've accrued on the price appreciation of that asset to date. So those are the basics of how the tax works. When you become a non-resident, there's a deemed disposition, meaning that you're charged taxes on all of your unrealized capital gains to date, which is actually similar to what happens when you die in the country. So I guess that's how Canada views it. We are deciding to leave the country, so you're dead to them. So they're settling up their accounts. Now, politics of all this aside, deemed dispositions are a very common pain point for Canadians from a tax planning standpoint. For one, because you're realizing all of your capital gains at once, it can very commonly push you into higher income tax brackets, meaning suddenly your income tax might surge in that given year, despite potentially not being a higher than average income earner. And secondly, because you haven't actually sold anything, you may not have cash on hand to cover the tax bill, which might actually force you to sell some of your assets. This is especially common for things like cottages. A family member with the family cottage passes away. The property has a really low cost basis because it was bought 40 plus years ago. And the family is forced to sell the building because it's experienced this massive appreciation and they don't have the tens of thousands of dollars they might potentially need to keep the property. Now, in terms of what this tax actually applies to, as highlighted by the Government of Canada itself, it's pretty far reaching beyond just financial assets like stocks and bonds, with things like jewelry, paintings, and even collections also being subjected to the tax if they've appreciated in value. However, it only applies if the value of the asset exceeds $10,000. So your wedding bands and Naruto posters are perfectly fine. The tax also only kicks in if your total assets are worth over $25,000, and Canadians can actually unwind the tax if they end up returning as a resident. Regardless, you can see why some are critical of these types of deemed dispositions, especially when they might force someone to sell something they treasure or value. But it brings us to the first main caveat around departure taxes, which is the long list of exemptions that for many people means they'll never have to pay any departure tax. For one, registered investment accounts and a long list of financial products are all entirely exempt from it. This includes pension plans, registered retirement savings plans, registered retirement income funds, tax-free savings accounts, registered education savings plans, registered disability savings plans, annuities, employee profit sharing plans, and many more. So for a person who holds all of their investments within an RRSP, TFSA, or potentially a pension plan, there's no departure tax owed when they become a non-resident. In part because some of these things like the RRSP can be taxed by the government after you've left the country when you withdraw from the account, so there's no need to tax it at departure. Another big exemption is Canadian real or movable property, Canadian resource property, and timber property. So any Canadian real estate is completely exempt, meaning that that cottage situation wouldn't come up here. Although foreign real estate is not included here. This is specifically for property stuck within Canada's borders that again can eventually be taxed when the property is sold. Then there's an exemption for short-term residents whereby assets owned before or inherited during your resident period may be excluded. And finally, there's an exemption for any Canadian business property for business carried on through a permanent establishment in Canada, meaning assets like inventory for an active business in Canada wouldn't be subject to departure tax. So for most people, the biggest impact from departure tax will be on their investments held outside of registered accounts. And listen, there's plenty of room to criticize Canada's general tax regime. But with departure taxes specifically, there's a very rational reason that the country charges it beyond just Canada being a tyrannical communist hellscape that's trying to entrap its citizens, which is what X keeps trying to convince me of. If there were no deemed disposition when someone left Canada as a resident, then people with sizable capital gains would be incentivized to leave the country for someplace with no capital gains tax, like Dubai, to sell their holdings. Meaning not only would Canada lose a potentially high income tax earner, since people in higher tax brackets tend to have the largest capital gains, but the government would also miss out on all the tax revenues from the capital gains that accrued from within their borders. Now, you might not agree with that reasoning, but it's why 5 of the 7 G7 countries and a number of other developed nations like the Netherlands, Norway, Australia, and South Korea all charge some form of expatriation tax when you leave the country, with the US itself, again, having its own version. So while Canada has found itself in the crosshairs of this conservative commentary, the concept is far from being uniquely Canadian. But Richard, you might say, Gad mentioned paying taxes of over 55%. Surely that's an unfair form of departure tax. Well, yeah, I'd actually agree with you that the government shouldn't take more than half of what you've earned in capital gains when you leave the country. Except that's not even close to what the departure tax rates are. You see, Canada charges income tax at both the federal and the provincial level. The actual rates you experience will depend on where you specifically live, but Gad lives in Quebec, which is the country's predominantly French-speaking province, known for having the highest tax rates in the country. So we'll focus on that set of tax brackets. And you can see on screen that the combined marginal income tax rates do get quite high. At over $258,000 a year, you hit the combined rate of 53.31%, meaning for each additional dollar you earn, you send over half of it to the government, which isn't quite 55%, but yeah, quite high. However, if you remember from earlier, capital gains are taxed at half of your marginal income tax rate, meaning the highest level that your capital gains tax can reach is 26.65%, which is actually less than the capital gains tax in some US states, like California. And again, this is only tax on the gain of an asset, not its entire value, and it's the marginal income tax rate. So every dollar earned below these brackets will be charged at lesser amounts. Plus, there are the deductions, like the basic personal amount, whereby the first bit of income is tax-free. So switching to normal income taxes for a second, even if your income puts you in the highest marginal tax rate of 53.3%, the total percentage of your income that you're actually paying in taxes will always be less than this. And your departure capital gains tax will be half of this rate. So you can see that the standard departure income tax rates are well below that mentioned 55%. Now, Gad might have been just referring to general income taxes or combining it with other taxes like sales and the like, but it is a bit confusing in the context of a broader discussion of departure tax. When you see 55 or 65% plus brought up, it can clearly lead people to believe that those are the prevailing rates. But there is one area where departure taxes can hit quite hard that is likely applying to Gad's situation, and that's around private corporations, something Gad explicitly brought up in the online exit tax discussion. You see, in addition to being a paid professor, Gad also earns royalties from his books. It's very likely that he's incorporated his royalty business so that he earns the royalties into a company, or corporation more specifically, rather than to his own name directly. Now, there's a number of benefits to incorporating in Canada, but a key one that's coming up here is tax deferral. Now, this gets quite complicated, but without getting too much into the weeds, corporations pay lower taxes on their income than individuals pay with their income taxes. So if you earn royalties into a corporation, then you'll have more after-tax money that can be invested while the money is held within the company. Now, the benefit is offset when you eventually draw the money into your own name, which you can crudely think of it as the second part of the tax bill comes due. But there can still be a tax efficient strategy benefit there because you can time your withdrawals to optimize your marginal tax rate and overall reduce the tax bill you'd be paying versus if you had just taken the money in your own name. However, when someone with a private Canadian corporation leaves the country, there can be two key impacts. The first is that the privately held shares of that company, so Gad's ownership of this private corporation, is itself subject to departure tax on unrealized capital gains, meaning Gad is being taxed as if he sold his royalty business at fair market value. And because it seems very likely that the cost basis for a royalty business like this would be pretty low, it means most of that value will be considered a capital gain. So if Gad's royalty business were valued in the millions, that alone could lead to a tax bill in the hundreds of thousands of dollars. Now, naturally, that depends on how the private business is valued, which isn't a clear-cut thing. There's no public market value to easily derive that figure, and the Income Tax Act doesn't define a methodology for valuing private businesses. It just has to be defensible in court. But needless to say, you can see the issue here, right? You have this valuable asset that appreciated from very little. The business itself likely isn't easy to sell quickly because it's private and very much tied to Gad himself, and the capital gain is being recognized all at once. The second hit is that if the corporation itself is deemed to become a non-resident, which can occur when the owners become non-residents themselves. There is a deemed disposition on assets held within the corporation, plus a 25% additional tax on the net value of properties on exit, less certain amounts including paid in capital. Meaning that the corporation that was set up for tax planning purposes can see all of these capital gains come due, plus 25%. Now, the purpose of this additional fee is very similar to the general purpose of the departure tax as a whole. Canada doesn't want people to have their corporations leave the country and have those people withdraw the assets before they pay that, again, crudely put, second half of that tax bill. So the 25% is somewhat meant to offset that initial tax efficiency or savings that owner receives. The rate may be reduced if there's a tax treaty with the destination country and in other certain circumstances. And we also don't even know if this even applies to GAD's situation. But this could be an area where departure taxes for the corporation specifically could exceed that 25% rate. Now, if this type of departure is something that wasn't planned for from a tax standpoint, it's easy to see how it could be a source of grief, especially if it ends up putting you in a worse situation than if you hadn't incorporated in the first place. However, the 25% tax specifically is really just undoing that initial tax benefit. That 25% additional fee could be avoided by simply pulling the money out before you leave. And regarding large gains on private shares specifically, there's one last exemption that can offer a big break here: the lifetime capital gains exemption. The LCGE allows a person to exempt up to $1.275 million of their capital gains, with this amount increasing each year based on inflation. So if a qualified business had a $0 cost basis and was worth exactly that $1.275 million with a deemed disposition, meaning the entire amount would be considered a capital gain, they would pay $0 of capital gains tax if they used this lifetime exemption. Finally, around that issue of forced selling around private company shares, it's worth noting that the Canadian government allows departing individuals to defer payment of this departure tax. It's called a T1244 election, and it can allow people to defer departure tax payment until they actually sell the asset. In other words, turning the departure tax into just normal capital gains tax. Now, this election can require posting security when the value of the property exceeds a certain threshold. So that's an important aspect to consider, but it can help avoid that cottage situation, or in this case, being forced to sell your private business, because you might be able to post the shares themselves as the collateral you need. Now, hopefully this is all demonstrating that the topic gets quite complicated. And again, we don't know GAD's specific circumstance. There may be a specific ruling or exemption that we're not covering here. But specifically when it comes to the personal Canadian departure taxes that people face, there are, again, a lot of exemptions. The rates are much lower than people might be expecting based on the online discourse, and it's only on the capital gains, the current market price minus the cost basis, not the total asset value of what you take with you. In fact, the main disadvantage of the tax is that it brings forward what would otherwise be a future tax liability, which the country does to ensure that you won't stiff them on that future tax liability. Now, one point of discussion that's arisen with all this is how Canada's departure tax compares to the US, because one detail that was glossed over by a bunch of comments is the fact that America has its own sort of mark-to-market exit tax. I won't go into as much detail, especially because it's an area that I'm not personally familiar with, but it's a similar deemed disposition that charges US capital gains tax if you're a so-called covered expatriate, which effectively means you're a high income earner or you have a net worth of over $2 million. But the key difference with the American exit tax is that it's only charged on a change of citizenship, not residency, meaning that even if you leave the United States, you won't inherently be charged this exit tax, mostly because the US has a pretty unique citizenship-based tax system. If you move to another country but retain your American citizenship, you have to continue filing American taxes and may even owe taxes to the IRS, even on income earned in that other country. Now, the US does have a number of tax treaties with other countries so that Americans living in those countries get a foreign income tax credit on their US taxes, meaning that sometimes they won't pay any taxes to the IRS depending on what they pay in the country. But otherwise, Americans are taxed US income taxes on worldwide income earned, regardless of where they live. So yes, US exit taxes are only charged when someone actively renounces their US citizenship. But the reason for this is that the country doesn't face the same risk of someone leaving the country to try and evade taxes because the tax system isn't based on residency. It's based on whether you're a citizen or not. So when you eventually sell those assets that have capital gains, a tax bill will come due, whether you live in America or Dubai. Now, to be clear, yes, the US tax system is generally more favorable than the Canadian system, but Canada's departure tax is really just a front-loaded capital gains tax. And while certainly, again, there's room to discuss and debate those things, and they should be, it's also important not to misrepresent these concepts, especially when things get political. Now, if you're a Canadian who knows you're going to face a deemed disposition in the future, there are strategies for mitigating how much you pay in taxes, things like recognizing capital gains prematurely to smooth out your marginal tax rate that you end up paying. And I highly recommend you reach out to a qualified tax accountant to help with those strategies. But hopefully, again, when it comes to the broad strokes, this video helped to clear up some of the common misconceptions. Thanks for watching. I hope you found this video helpful. If you did, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts on Canadian departure taxes and departure taxes as a whole, since again, this isn't a uniquely Canadian topic. Thanks again for joining me. And as always, be safe out there.